Hey folks, welcome to a portfolio review at Finominal. Today we're going to look at Invesco's strategic focused ETF 80-20 portfolio. Now, the 80 refers to an 80% allocation to equities, and the 20 refers to 20% allocation to primarily fixed income. So let's see how this portfolio stacks up. If we do look at the constituents, we do see that there are 13 Invesco ETFs and a 2% allocation to cash. From the kind of ETFs that kind of like dominate, we can see there's a 20% allocation to the Invesco S&P 500 quality ETF. We can see the second largest allocation is to the Nasdaq 100, and then thereafter it's the Russell 1000 Dynamic Multi-Factor ETF. If you look at the other portfolio constituents, we can see there's again, S&P 500 top 50, revenue, low volatility, then we have a bit of a bond ETFs, then dynamic multi-factor, and all sorts of other ETFs, either from fixed income or equities. From a total fee perspective, this portfolio charges 22 basis points, which is cheap, right? So that speaks for them. Now, a simple benchmarking exercise shows that for the time between January 2023 and today, so we have roughly about, 2 years of data, and that's simply because some of the ETFs in this portfolio were launched not too long ago. We can see that the performance was almost identical to kind of like a 80-20 benchmark portfolio, which is simply the S&P 500 and US investment grade bonds. So that's to a degree expected, but of course you would also expect some differentiation to the positive, right? And we don't see any of that here. In terms of trying to see what this portfolio has been, what kind of explains the drivers of this portfolio, we do of course see that from an asset class perspective, it's primarily, you have a very consistent exposure to the S&P 500, you have some exposure to bonds, and kind of no exposure to currencies or commodities. Now, that's as expected. From a factor exposure analysis, this portfolio contains a lot of smart beta ETFs, right? So we do see, almost consistently positive exposure to value, momentum, quality, and the size factor. The only kind of like more mixed exposure is to low volatility factor, where the exposure was negative historically, but then became positive. And that might be simply explained by these kind of multi-factor ETFs within this portfolio that may change allocations from being underweight low vol stocks to overweight, right? That might be one explanation for that. Having said that, if you do look at the resources of this portfolio, we do see that almost all of the risk can be attributed to the S&P 500 in both years. And that's simply because these factor exposures that we just saw up here, they're very small from a magnitude perspective and really didn't matter that much. Now, that kind of brings me to the question if this portfolio was constructed thoughtfully. And just looking at those factor exposures, looking at those holdings, where I can see there's a multi-factor ETF here, there's quality, there's low volatility. I already expect that there might be some factor exposures that net themselves off. And we can quickly check that by going to the risk exposure analysis and looking at the holdings. So over here, effectively, we see again the different holdings and so on, right? And we can go to the betas to the various factors. So over here, for example, you can see the beta to the value factor, and we can see that quality ETF has a negative beta. We can see the Nasdaq has a negative beta to value because Nasdaq's stocks on average tend to be expensive. But then we can see the multi-factor has a positive exposure. It's like a negative exposure, positive exposure. So effectively, what happens over here is that if you combine ETFs that have opposing factor exposures, they net themselves off. And the same thing happens with momentum, quality, and volatility. And so that just means that, Invesco in this case, right, they just added too many different flavors, right? And as with cooking too many flavors, like they kind of destroy the taste. So that's certainly one criticism of this portfolio. Then the two remaining questions is, can fees be reduced? So fees are 22 basis points for the portfolio, which is cheap, but we can see that for every single fund, we have a cheaper alternative, which effectively means we could reduce the fees of this portfolio from 22 basis points to 8 basis points. And that's simply by swapping in similar but cheaper funds. And you can see from a performance perspective, you would have still gotten the same return, right? So if you want to reduce fees, you can. Now the final question is, can we simplify this portfolio? It contains 13 ETFs plus cash, and that just is complicated, right? And it's fine to have a complicated portfolio if the portfolio creates value. Having said this, in this case, a very simple combination between the S&P 500 and US investment grade bonds in an 80-20 weighting scheme would have virtually given you the same profile. And again, fees could be reduced from 22 basis points to 8 basis points also in this case. And so you can basically replicate the portfolio right at a lower cost. And that kind of summarizes or concludes our short analysis of Invesco's strategic focused ETF, with an 80-20% allocation to equities and fixed income. It exactly does what you expect it to do, right? From an allocation perspective, it's cheap at 22 basis points. But having said that, right, you can certainly reduce fees further. You can simplify it, and the complexity, right, the different securities in here just haven't contributed any value. I hope that helps. Have a nice day.